All right, well, I might kick us off in a minute. I'll just give 1 more minute. Should kick us off. What time actually is it there, Rachel? Is it
6:30?
6:30. Oh, thank you very much.
My pleasure.
So it's all right. I'll just 1 minute and then I shall kick it off. All right. I think I may start if we're all ready. So thank you everyone for joining us today. First of all, on behalf of those present, I'd like to acknowledge the Gadigal of the Eora Nation as the traditional custodians of this land I'm presenting on and pay my respects to elders both past, present and future. So let's get started. For those of you I haven't met, my name's Amanda Price. I'm the head of High Growth Ventures, which is a team within KPMG dedicated to working with startups. We have a range of services specifically priced and designed to support founders from pre-Series A and beyond. So today's topic, very topical topic, is conserving capital and extending runway. So practical tips for founders to slow cash burn in the next 1 to 3 to 6 months. I think it's impossible now to read anything or listen to anything and not hear that founders need to conserve capital and extend runway, but it can be tough to know what this actually means and how to do it, especially if it's the first time that you're experiencing a downturn. So luckily for everyone today, we have 3 experienced people who have no doubt gone through a few downturns, or 2 perhaps. Charlie. Sorry. And 3 people who've got different perspectives as well. So we've got Rachael Neumann from giving sort of a VC perspective. Rachel's a very well-known figure in the Australian startup scene. She's got experience working in startups and scale-ups. She launched Eventbrite into the Australian market in late 2014. She's experienced working with startups. In 2019, she was the head of startups for AWS for Australia and New Zealand. And she's also an experienced investor. She's a partner at StartMate since 2016. My God. And a founding partner at Working Theory Angels and is currently the founding partner of Flying Fox Ventures. We've got Charlie Woods he's the CEO of Wiise to give us the perspective from a founder. This is in your bio, Charlie. Charlie's a 25+ year veteran of the technology industry, covering business leadership, VC investing, strategic consulting, marketing, product management. He's built 2 startups, mentored many through fundraising, product market fit and scalable go-to-market activity. But the thing that I like most on Charlie's LinkedIn page was this highly entrepreneurial spirit. Carry a bag, do the PR, police the messaging, build and protect the brand, do whatever it takes to grow the business. I love that. So, and Robyn Langsford, last but not least, partner at KPMG. Robyn really works across the startup ecosystem. She leads our outsourced CFO practice, working with founders at all stages of growth, helping them to develop and mature their finance function. And she also leads our family office high net worth practice, many of whom are looking to deploy capital into startups. So yeah, big welcome to the 3 of you and thank you very much for joining us. Also, just a call out to the audience, many of you have submitted questions which we've used as a basis for the questions we're going to ask the panellists, but we want it to be as interactive as possible. I've got the chat on. I better put the chat on. I'm putting the chat on and I will just keep note of questions that are coming through and I'll weave that into the conversation if I can. So just to start, as I said, we are all being told that we need to I'll go back. If we can I might just turn to all of you to get just your observations or your thoughts on how the change in market conditions are impacting you and your business. Rachel, I might start with you.
Sure. Thanks so much. And thanks for that intro, Amanda. You basically were just qualifying, not our skills, but our age, just to say these folks have been through a cycle or 2. So yes, indeed. And I'll just give you context. So I'm not that old, but I don't know if it was coincidence or causality, but I was at Stanford doing my undergrad in 99 to 03. And so we all know what happened in that space of time. And that was the tech bubble and the tech bubble bursting. So I saw all of my classmates leave to go become billionaires. And then I saw lots of them come back with their legs. And so while I wasn't at, the belly of the beast at that time, I did have a front row seat to everything that was happening. And then fast forward to New York, I was in business school in 07 to 09 at Columbia. And I was literally at the ground level of the global financial crisis. And so I would have people coming into my class from big prestigious banks. And the next day, literally those banks had evaporated. So again, I was very fortunate to not be deep in it, but had a full front row seat. So got to see 2 boom and bust cycles. And so it just makes me feel like as we're coming into what might be a downturn now, I don't necessarily have the direct skills, but I don't have the fear that I think a lot of people have, because I had the advantage of watching those folks manage through it highly effectively. And I've been collecting the data points of what it means to manage highly effectively. And I think the 3 of us, and you, Amanda, are going to talk through some of those today, but that's just some rambling context from an old gray-haired woman. If I zoom out and answer your question around how this is affecting us, so I'm in the venture capital space, and it's my job to find outstanding entrepreneurs and put fuel on their fire to help them grow iconic companies. I am not seeing any fewer amazing founders to back, so those folks are still out there, which is wonderful. But we are seeing things get hard. You know, last year, 2021, over $10 billion of private VC capital was poured into Australian companies alone. And so last year was the top of the roller coaster. And I think we are, you know, the tune has changed certainly over the last 6 months. So what are we seeing tactically? Like, we're seeing it's harder for folks to raise. It's taking longer for folks to raise, and the terms are not as favorable. And I think that, and again, we're going to talk in depth, but it is not all doom and gloom. Great companies still exist. Great companies are out there getting funded, but the ease and the fervor with which capital was flowing last year has certainly changed. I feel very lucky because I play in the very early stage. So I was least impacted by the valuation bubble. And so I'm least impacted by the little pop that's coming. So I'm still very bullish on this asset class. I'm very bullish on this stage. I'm very bullish on Australia. But things are certainly different than they were last year, and we'll talk about it, but I'll pause there. Thanks.
Thank you. Robyn, might throw to you.
Yeah, sure. Thanks, Amanda. I think, yeah, we're still seeing quite strong confidence from businesses in general, probably more so than from the underlying consumers, but there's definitely been a slowdown in capital flows, and definitely from the investor perspective, much more cautious in their investment appetite, as Rachel alluded to. So in response to that, we're seeing founders realise that they do need to really focus on extending runway, which we're going to talk about more today, until markets settle again, and then they can potentially access capital a little bit more easily than they may be able to currently. My perception is that last year, you know, family offices were very keen to invest. There was almost a FOMO, a fear of, you know, missing out on the deal, and there was like a sort of a race to invest all the time. Now, while I wouldn't say there's a fear of going in, there's a much more cautious perspective to going in. And so I think that there's probably it's probably too strong to say that there's a fear of missing out, but there's definitely a more cautious approach out there from investors. And I think founders probably need to think through as well that family offices have long-term patient capital, and so they're really happy just to sit on their capital and wait for the long term, see how the economy settles. If the right opportunity comes along, they may still invest, but that whole fear of missing out on the great deal has probably slowed a lot.
Right, thank you. And Charlie?
Yeah, I've got a bit of grey hair as well. So I'm an operational CEO of Wiise, but I also play a number of different roles. So I'm an LP, which is an investor in a few funds as well. Also venture partner at things like Antler, and then also board advisor and go-to-market advisor at a couple of companies. So I get to see quite a lot of different perspectives right now. Going back to sort of have we ridden the storm before? So I only moved to Australia in 2008, which was we quit the US right at about the evening before the market crashed, which was great because we sold our house, which was probably going to be worth about 40% less the week after. But we built a company. I built a company here in the middle of that storm, and it was kind of a good thing to do, because if you take what Rachel was saying about not having any fear, like if you don't fear it, then you know it's actually not that hard, and you just have to plan appropriately. And sure, you know, access to resources and capital can be a bit tighter, but if you can build something strong that's you know, in a market that's less than favourable, then as you come out the other side, then only good things happen. And actually, with my little venture a few years later, we had ended up getting acquired by Salesforce, right? So it's a great little story. But what am I seeing right now? So I'm, I run a business which is wholly owned by one big investor, and they're very nice and they're very patient, but they're also very diligent and quite financially literate. So I've got to keep my business sort of performing really well, and the agreement there is I keep efficient, I keep growing, I keep being responsible to the capital that's available to me, and do the right thing, and keep it within a set of pre-agreed boundaries. I think that's pretty important. And then just broader discussions. Actually, I was away at the Innovation Bay Summit Expedition, which obviously KPMG High Growth Ventures support, and a whole bunch of CEO and founders were having a discussion about the availability of capital, and a bunch of things came out of that, which it's pretty obvious if you're following the press, right? So it's harder to raise a new raise. The big VCs, a lot of them have raised a lot of money. You've seen a lot of that news recently. So the big 4 to 8 have recently raised another fund. There's a lot of older money and super fund coming in at the back end, but there's a perception that they're keeping their powder dry, right? So they're looking after their own portfolio companies because they want to preserve them through any downtime and to any downturn that's coming this way. So exactly as Rachael and Robyn was saying, so new investments are a little bit more tricky. Valuations need to be a little bit tighter, but where there's a will, there's a way, and where there's efficiency, you can tell a good story, I think.
Great, thank you. Okay, so I think we're all agree, like one thing we're all hearing is this conserving capital, but it's not quite as simple as just stopping spending, because every dollar has impact. So how do founders understand the priority around that impact? Like, do I cut marketing or tech? Do I reduce the size of my team? We know this is hard and it's different for every company and stage of growth, obviously. But Rachael, it'd be good to understand, how are you advising your founders to think about this?
Yeah, and so, conserving capital, there are two ways that you can do that, right? One is by reducing your spend, the other is by increasing your revenue. And so as long as the unit economics are there, it's good to increase revenue. Like the best, we always say, the best place to raise capital is from your customers. But the key there is that previously a lot of VC money was thrown at growth at all costs, and that's get revenue while the bottom line gets in the red and further down in the red. And so really, this is boring, but what I keep saying to my founders is it's time to get back to business basics. It's time to first and foremost really focus on your strategy. So I'll say, hey, founder, what I loved about your company was that there were so many places that you could go and so many things you can do. What I need you to do right now is pick the top 2 things, right? Really prioritize, ruthless prioritization of where you're going to put your energy and your resources. And then once you've prioritized, really understanding those unit economics, understanding a dollar in, how many dollars out does that get? And when I say dollars out, it's not necessarily revenue, because everyone's metrics, especially at the early stage, are different. It could be around, acquiring customers, getting engagement. It could be about product. But what is the input and what is the output of that dollar? And how can, as Charlie said, how can you get super efficient around that? So first of all, at Flying Fox, I look for capital efficient companies. And so already when they've come to me, I have invested in them because they've demonstrated some sort of capital efficiency. And so I feel like I'm at a good start, but I am encouraging them, really focus on your key priorities and then figure out where's the most high impact spend you can make. That doesn't mean stop spending, right? Because there are no companies in my portfolio right now where it would be a good idea to just chug along and cruise. That's not why we're in the VC business. We're in the VC business for really outsized returns. These companies have that potential. We're just asking and supporting our founders to be highly strategic and highly thoughtful. I'm sure we'll talk about it, but right now, this is a great time that talent's coming into the market. I would not tell people to lose their wallets. I'll pause there because I have a feeling that there's a whole conversation to be had. But again, it's just being very thoughtful and strategic about spending, and then being very thoughtful and strategic about where you get your revenue. When I was a management consultant, we had this idea of bad profits, right? There actually are some customers that aren't worth going after. And so also being thoughtful around where do you not get revenue so that you can focus on your best customers who can, you know, help grow your business efficiently through referrals, etc. It's really, really business 101. And I think KPMG is going to be putting out some great lessons on these very topics to founders. So stay tuned for that. But yeah, it's time to get back to basics.
And Charlie, how does that resonate with you as a CEO of your business? How is this all sort of playing out? And are you doing anything, or what are you doing differently since we've seen the market change?
Pretty much exactly what Rachel said. So I just listen to what Rachel says and just do it, really.
We all do. That's all we do.
No, so it's exactly those things, right? It's have an understanding what efficiency actually means, right?
Yeah.
So whether that's with your existing investors, your board, your management team, is like, what does efficiency actually mean? And it's not just cutting costs for the sake of it, right? We all know where, if there's some obvious costs we can cut, we'll cut them, right? So it's not a lesson in that. It's a lesson about how do you continue to grow the business at the same pace or better with the same resources, or fewer, or make those resources last longer. So it's an agreement about what that efficiency means. Does it mean austerity? Does it mean having a clear understanding of how you're going to improve the efficiency and the output of the business over a period of time? That's probably a better conversation, right? And then this notion of efficiency, like what does it actually mean, right? So the old school measures and metrics on that, LTV to CAC, you know, lifetime value to customer acquisition cost, you know, you Google it and it's sort of 3 to 1, you know, less than that, you're going too slow, more than that, you're going too fast. But that's a really blunt measure. That's like, you know, buying a horse by the yard or buying a car by the meter, right? Because, you know, the item can vary. So you need to get more granular than that and understand what it actually means for your business, right? So there's a whole lot of different things. So there's one that I use, which is, it's called the 10-40-80, which you spend about 10% of the first year's ACV of a deal to generate the total number of marketing qualified leads it takes to close that deal. What that means is now you can put a dollar value on every single MQL. And if you can operate at 10, 40, 80, then the 40 is the bit from an SQL, sales qualified lead, to close, and then onboarding. So if you can run at that rate, that's your loaded cost. And then if you're B2B SaaS, then typically you want to run your platform at about 80% gross margins, so that 80% is your cost to serve on the other side. You've got a great business. Now, obviously, there's different businesses that vary around that, you know, B2C, different platform businesses, there's product businesses, but there's a version of that that will work for your business. The benefit of doing that is you can clearly calculate the targets of, like, the financial targets and the costs of all of these elements. And then what you'll do is you'll use that as almost like a forensic tool. This is what I've been doing, is to go across the bow tie. We call the bow tie. So you take a sales funnel, typical sales funnel, tip it on its side, that's one side. And then the other side, from onboarding to renewal to LTV to, you know, upsell, is the other side. You end up with a bow tie. So we start left to right. You know these numbers, you know these benchmark numbers, you know these design numbers. So you can go, right, am I creating my MQLs, my customer top of funnel stuff, at the right cost basis? And if you're not, why not, right? Understand why. Am I hitting the wrong customers? Am I serving ads in South America when I don't sell in South America? You know, there's like a whole load of things you'll find. And then the next bit is around customer selection, right? Only deal with customers that are going to buy. And that's a huge, like, it's a really great piece of work to do in your business. And probably one of the most impactful things you can do in a relatively short term to add to your top line, reduce costs and increase efficiency. But I'll pause there because we could go on forever about that kind of thing. But that's what we're doing with Wiise right now, is we really are modeling our bow tie, looking for efficiencies. And then I've got a capital efficiency metric measure, which relates kind of to the investment, or the amount of burn that we have and the amount of new ACV we add every year. I'm trying to get that ratio of like 1 to 1 as quickly as possible. And so we plot the business out over multiple years. We agree with the board and the investment that we're heading this direction. And as long as that metric's improving, we're not running out of cash, we're becoming more efficient, we're really transparent and honest the way that we manage the finances of the business, then people are happy, right? And then, you know, VCs are more likely to invest and continue to invest with you if you've got a good story.
Yeah, and just on that, Charlie, the one point you mentioned about targeting the right customers. A while back, Charlie actually came in and helped High Growth Ventures with quite a few things, and I'll touch on those. But one of the really impactful things about the customer selection was we did an exercise. Remember, we went back through, we went and examined and really looked. We use a framework called SPICE, situation. I'll say it wrong, so I'll just say Charlie, situation, pain, impact, critical event. And there's this qualifier you look at each client that you've won with this framework, and what it gave us was a really understanding of what situation were they in when they, for example, needed outsourced CFO. What was the pain they were feeling? What was the impact they wanted from the product? What was the critical event? We did this over and over again per product with our customers, and we started to get really clear on the types of customers who were buying from us, and then you can do it with your lost as well, and then you get clear. But I think that really stands out for us with the team, because if we talk about efficiencies, one of our things, we did not understand why people were buying from us at all. And so I thought that, and also probably just a shout out to a lot of the way that we've built our business, and some of the things Charlie's referring to comes from Winning by Design, which Charlie, just want to give a bit of a shout out to, just to explain, because I think it's a good thing, because there's so much online about it that people can go and have a look at it.
Yeah, I'll put some notes in the chat, because there's a whole bunch of open source blueprints that you can just go and take a look at. That's pretty cool. But I've got one sort of fun story, which was sort of pre-understanding the Winning by Design way. We learnt it the hard way, and it was really impactful. It's a great story of this. So when we were running Dropbox, we're selling Dropbox to the enterprise, right? It was a bit of a hard job back in 2005, 2006, and we'd have two customers in the pipeline at that late stage, which is always the dearth of B2B tech salespeople, deals that just won't close, right? And they're there because they inflate your pipeline numbers. They give you a false horizon, think you're going to do great, and you always go, we close a third of the dollars in the pipeline. And then there'll be two deals, and one would close and one wouldn't, right? And they look at them and they go, they're exactly the same. It's the same type of company, the same industry, the same geography. What is the difference? And if we'd have had this lens of situation, pain, impact, critical event, we would have figured it out much earlier. The way we figured it out was actually one of the grads ran a script against the DNS to look at the MX record of all the people in the pipeline to figure out where they put their email. Now, if you were on Gmail or a cloud-based Office 365 or something like that, then your decision maker was into buying cloud tools. If you had Lotus Notes or on-premise Exchange or some legacy, God knows what you bought from a telco, then no one's buying Dropbox, right? And the great thing we did there is we just took all of those people that were not cloud, that were never going to buy from us, and we just got them out of the pipeline. Well, we put them in a nurture campaign. Two things happened there. It got rid of the false horizon of pipeline and forecast that was never going to close, and it left the ones that we could spend time with, and our close rate went up and our revenues went up. And then we went looking for more of the ones that looked the same with that little nugget of information. So just like we did with High Growth Ventures and Amanda's team, we figured out what particular is good about these customers and what's the moment they're in and what's the pain that they're at. So yeah, cool. I'll put a note into the open source.
Yeah, I just think it's been a game changer for us. And Robyn, obviously you're working across all of our startups, really, most of our startups, and they're all from different industries and different stages of growth. Have you got any examples of founders that you're seeing sort of are approaching this well?
Yeah, I guess just to get the background context, I guess it's been really interesting, seeing the transition from the environment of 12 to 18 months ago where, we did have plentiful capital, and to a degree then I did see a lot of founders relax and apply a less rigorous approach to the way that they are actually spending the capital that they'd raised. And I mean, Charlie's just given some excellent examples as to the rigour that he applies in running his business, and that's just been fantastic to listen to, and be a great example for founders on the call today. And I think founders also would do well to remember the economic environment that their investors are sitting in. I mean, lots of times I find founders are very consumed with running their business and pouring their heart and soul into it, and rightly so. But just remembering that, the investors themselves, we're seeing an environment of high inflation, high interest rates, the US stock market's crashed overnight. So investors are incredibly cautious, and they do want to see founders applying rigour to the capital that they've given, rather than sort of having a free-for-all or a little bit more of a relaxed approach to it. And so, yeah, just to touch on Rachel's earlier point, definitely founders need to be focusing on really looking at how they can increase revenue, and not just increasing revenue at all costs, but really thinking about how they can do it in a sustainable way, and growing with efficiency, as Charlie's touched on as well. And then really thinking through the expenditure side, and as Rachael said, not stopping expenditure altogether, but really thinking through what's the non-essential spend here? Do I need my fourth or fifth marketing person? Do I need to have everything in-house? Can I access particular skill sets or services that I need to consume at a cheaper price point by outsourcing? And really thinking through those harder decisions, is really important. We're in a market where the balance has really tipped, I think, in the investors' favour for a while, and they'll be looking at their startups they've invested in through a performance lens, and so it's really important to apply that more rigorous approach to the capital that you're deploying.
Actually, I might just ask then, what are, like, obviously there are some very obvious things we can cut down, and Robyn, in your experience, is there any sort of non-obvious, what are the non-obvious things that we should look for that might not sort of be jumping out to us?
Yeah, so the big thing I would say here is, and founders are no different to all the rest of us, but the whole sunk cost fallacy. I think sometimes we just, founders in particular, feel wedded to pursuing a strategy because they've invested so much in it to date and we just can't bear to part from it. And you really, you can't afford to be trapped by that. You need to abandon a strategy if it's not working, rip the Band-Aid off. And if you need someone to help you do it, reach out, because pursuing strategies that don't work, you're just pouring precious capital down the drain. So that's the first and foremost high strategy level thing I would recommend all founders actually do as a first step. And then I guess there's a number of other sort of more practical steps that founders can take, looking at the non-essential staff you might have, really thinking through what is the incremental benefit to the bottom line of each staff member that I have. Do I have non-core staff that potentially I don't need to have in-house? Sometimes founders can get a real buzz from having a big team, and that can be really great, but that does come with a lot of flow on non-financial costs of managing people and all the obligations that come with that. And so once again, I guess it just comes back to, are there various non-core functions that you could potentially outsource, access the same capability and skill set, but at a cheaper price point? So thinking that through. Also looking through things like subscription services, particularly to cloud-based type solutions. Sometimes these subscriptions just roll on and roll on and roll on and roll on, and you need to actually be revisiting those to actually make sure, do you still need them, and are you still getting the value from them? Retainers as well, sometimes retainer systems and anything that just sort of keeps debiting your bank account, you do need to revisit every so often and actually determine, are you still getting the right value from it, and do you need to shift to a different consumption model with that service provider? And as much as founders probably potentially don't like to do it, just doing the old, going through each line of your profit and loss and determining, is this item a critical spend? What would happen if I didn't have this tomorrow? Would the business fall over? And just really thinking that through in a disciplined way.
Yeah, Charlie, anything from you to add on that? Is there any expenses that you've popped up? Like last week when I looked at my Netflix and realised I had 3 subscriptions personally, which I don't know how that's happened, but anyway.
I was actually just laughing when Robyn was talking, because somebody in my household, who remain nameless, did lose their credit card recently. And it was a great cleanser, right? Losing your credit card, because you get all these notifications of things that can no longer access your funds that you forgot you subscribed to. So no, we've done this. We do this quite a lot, right? It is quite easy to get to, and I call it, you end up with a petting zoo of technology of subscriptions, right? But it is worth going back and looking through all of these things. Actually, a couple of good startups have come out of the Antler ecosystem recently that help you manage these things, where you put them all into one platform and it gives you a clear view. And there's even some good banking products that create a virtual credit card line for it, so you get to choose what the cancellation policy is rather than the other people, because I think we've all been online trying to cancel things. But otherwise, yeah, I mean, it's exactly as Robyn said. Let's go through things and look where we can get efficiencies. Certain roles and certain skills don't necessarily need to be on staff at the stage that you're at right now. And the other thing is, don't be scared to undo your mistakes, and blame it on the markets. People do it all the time. We saw it, Amanda and I saw it at the beginning of COVID. There's a whole load of people just blamed COVID, right? I'm closing that LA office I opened for vanity reasons that I probably don't need. And right the way up to, the big players, like you saw Shopify with their open letter from the CEO probably about 35 days ago or so, yeah. where really what they'd done is they'd openly blitz scale, taken advantage of everybody going online shopping, completely owned every segment of the market with unscalable unit economics, and then blamed cost of capital why they're scaling back and only, they'll only engage over a certain GMV. It's like people do this all the time. Use the market tension to make change, and if you're not wedded to that thing, as Robyn said, if you can see that there's a better use of your time, your capital, or maybe there wasn't a fit for that, then unwind some of your expensive mistakes perhaps.
Yeah.
Amanda, I just want to add, because both Charlie and Robyn mentioned, like that companies should be scrupulous around their recurring spend. For some of our founders, that might be their companies, right? And so this is a great opportunity for you to make sure that you are creating customer love, because on the other side, your customers might be scrutinizing their P&L and looking at whether or not your product is worth it.
Yeah.
And so this is just a great reminder. If you have had either captive customers or lazy customers who are just rolling because they don't even notice that it's hitting the, the company Amex, or they're captive customers because they were locked into a 12-month contract. All of these things are up for grabs now. And you should be thinking about, am I continuing to really solve my customer's pain point? Am I giving them incredible service? Am I showing them customer love? Because one of the best ways to grow, we've talked about how we want everyone to grow revenue. You could either keep acquiring new customers, which comes at a cost, both financial and effort-wise, or you can keep the ones that you have. So retention is the best way, and to make revenue. And actually, my best companies in my portfolio have net retention rates over 100%. So that means not only are they keeping their customers, but they're able to sell more and get a deeper relationship in. So this is a very important time, again, to think about how do you fix your leaky bucket problem, because if it was leaky before, it's only getting more leaky now as people are more judicious around their spend. And if your customers love you, how do you deepen those relationships, really create value, and extend through in other parts of their business, greater share of wallet, etc.
Yeah, and I think having a kind of notion that not everybody's roles are set in concrete, so you can be fairly fungible. So SDRs, or people at the top of the sales funnel that are great talkers and great relationship managers also make great customer success managers. Like, get on the phone, call around your customer base, have a chat to them, see what's going on, right? And that's it's the same role, same people, you just move them to a different part of the bow tie, and you can have really good impact. In fact, we're doing a little bit of that at the moment in Wiise. We're just shuffling people around into different areas of our bow tie to make sure that we've got good coverage all the way across, right? So yeah, we're not leaking at one end whilst we're loading up at another.
Yeah, and I think I've just thrown on that too. I think another thing is, it's funny, Fabio and I, who leads our sales team, yesterday I had a conversation with him around talking to the team around expenses, around travel, making sure they're aware of the budget we've got, living within that. But like, even those types of things, I hope they're all listening today. I don't think they are anyway. I'll be reinforcing it later. But I think that's another thing too, like bringing them in to take this on as a responsibility as a team that we need to cut, so they're very conscious of it. And just also, we've just put a few more, I think, not rules, but things in place to stop us going over that. So I think that but it was a thing I sort of thought, just to make sure that they're all very conscious of the spend, things like, don't take people to dinner if they're not customers of ours. Like, why are we, doing all of that type of thing? It's like, we don't do a lot of that anyway, but just making sure that we're not sort of spending money on those types of things. But a question came through the chat, which I'll just throw to everyone to see who's the best person to answer it. It's one of the key challenges we face is balancing R&D spending with business development costs to secure future customers. Can't speak. Keen to hear thoughts on this. Does anyone have a comment on that? Charlie.
Sure. Yeah. I mean, obviously we're trying to balance both things, right? So we're a little bit behind where we think we should be in terms of product. So we're investing a lot in product, effectively R&D right now. So we've just put on a new chief product officer and put many more resources, not only into development, but also into the product management. Now, there's two things there. There's one, we have to. We absolutely have to. It's it's one of the fundamental laws of the physics of the business, is that we've got to keep innovating, otherwise we become irrelevant and there is no business. The other thing is, because we've got a well-run business and we're being transparent and we're growing well, we actually have some decent capital available to invest in there. And now is a good time, because there's good talent in the market, right? So go back a little way, only maybe 6-12 months ago, it was incredibly competitive and very expensive to hire some of those resources that we're looking for. And again, this was a great conversation at the Innovation Bay Summit event expedition last week about the talent market right now. And there's a bit of a fear that you just got to pick up other people's recycling, because that's kind of the stuff that goes first. But there's actually really good talent in market, because some ventures don't make it. And the people in there can be incredible people, And actually another role I've just taken advantage of hiring. I've hired some very, very senior role somebody into a C-level role who ordinarily I wouldn't really be able to afford or might not be in market. And it was just due to market conditions and some complications with a US problem that he's in market, right? So I think if you can run your business and you've got that level of trust and efficiency and the capital available, double down on the investment. Now's a great time. Like if you're not scared, like like Rachel was saying, then now is a good time to continue to bolster and build the business. Because when we come out of this, I think one of the question was, how long do we think this bear market's going to last? I don't know. Who knows? But it probably won't be that long, right? You're probably more fearful that it's going to last forever, and it won't. But those that are going to do really well coming out of this, that they've got great R&D, great new product, great positioning, super efficient about customer selection and retention, and it's all the basics. But what it means is we're just running really good businesses, as opposed to grow at all costs and take all the money from SoftBank, right?
Yeah,
even they've stopped giving away money.
Yeah, I was about to say those days are over. Maybe. I think, Rachel, when we spoke last week, you was mentioning this as well. There might be some people in market that were on lower bases and sort of equity packages that now are probably might be looking for a higher base. Are you sort of hearing this in market as well?
Well, I can't speak specifically to the cost of talent, because I haven't seen those numbers kind of in a big enough sample size, but I am seeing, as Charlie mentioned, talent that was locked up, especially with the big companies, and they were locked up. Where they were locked up is because they had equity that they were waiting to vest, and when all of a sudden that equity becomes underwater, the wait isn't as worth it. And so it's not necessarily just the people who were cut because of a reduction in force. It's people who are saying, I've been holding out for this big payday, mate. It's not going to come in a while. I might as well do what I love. And so we're getting that talent back. And a lot of folks who've been sitting at those bigger companies, resting, investing, killing their souls, there's nothing they want more than to get back in on the ground level, work with an early stage company, roll their sleeves up and build something. And so this is where, my favorite founders are magnets. They're not just magnets for customers and magnets for capital, but they're magnets for talent. And this is when, good storytellers who can sell their vision can compel these incredibly talented people who have been in the cushy jobs for a while that are not going to pay out like they thought, to say, hey, come on, let's build something special. And so we recently had a talent specialist speak to our entire portfolio about not just theoretically what you should do, but tactically how you should think about proactively reaching out to these folks. And so we're seeing some really impressive new members join some of our portfolio companies. Just to touch on the original question around R&D spend, this is, to my earlier point about getting really strategic about what you're going to focus on. Please don't revert back to that product roadmap that you had, drawn out 4 years ago. So as you have adapted your customer strategy, and as you've learned more about your customer pain point, be extremely judicious about building the products and features that they need, because they're still experiencing pain or their pain has evolved. We always say product is a whack-a-mole. Once you solve one problem, another problem will pop up after that. So just keep paying attention to, if I've given my customer an incredible product, what is the next problem that has popped up? And so just a reminder, this is my thing and I'm very boring at this point, but be extremely customer driven in your product design. So by all means, continue to invest in your product. We know that, Australia kind of has abysmal rates on just percentage of GDP that we're putting into R&D in general. So like really, as Charlie said, if you're not continuing to innovate, there's another company in another market that's going to eat your lunch. That is absolutely true. But the best way to innovate is to stay really close to your customer, understand what they're asking for. There's a trick. Don't do exactly what they say. Translate that, understand their pain and then design a beautiful solution. But just stay as close to your customer as possible. And then it's very rare that you're going to go wrong from a product spend and a product development perspective.
That's great. Great advice.
Yeah, I think on the talent thing too, we're seeing, I don't know, the last month, we've had really interesting reach outs from people who have just come back into the market from the UK, from the US, really senior people who've had some sort of exits and things like that. It's just, I'm actually sort of going, we don't often, trying to refer, where do we refer them and put them? But we're definitely seeing, definitely an increase in some of the talents, like really experienced talents, especially now we're moving into that M&A. We're seeing a bit more M&A activity, and they seem to be quite strong in those areas too, which is interesting. It's just how to find those people. But
so actually, just on that, I've hired about 20 people in the last 12 months, and what I'm finding as well now is that where you find somebody you really like, you can generally get that hire done without somebody coming in and gazumping you, right? We had a couple of gazumpings where other people had got competitive offers, and some of them were crazy, and that's calmed down quite a bit now. So it's a little bit less competitive, which is ultimately going to give a bit of a downward pressure on salaries, because you're not having to pay the premium to capture the key talent. But it's getting a little bit that way. But there's still hard to find certain niche roles, of course.
Yeah, and that might speak even to the question that's just come through too around equity. I suppose, in terms of if there's less competition, do you need to keep what are the levels of equity they're giving away? What are the packages? Did you find that you had to negotiate hard on that, Charlie, or have you seen that change?
So I don't think there's much change. It's just about being fair, right? And I'm just sort of building an LTI, a long-term incentive plan for my team, and it's about balancing, seniority, tenure, and then contribution. So having some correlation between the amount and I guess the value of the potential exit and the upside for the real value and the contribution, because really what you're trying to do is tie the most valuable people into the business long term and make sure that they do well, right? Because it's not a good look if the business has a great exit and only half a dozen people do well. It's you want to spread the love with the team as well, because the chances are you're going to go and do it again anyway. So
yeah, and is there any, like when you're doing those sort of building those models, is there any frameworks that people can use, like to the question of is there anything that's standard, or even Rachael, Robyn, anyone that's seeing any standardization around the percentage of equity for roles?
Yeah, there are some benchmarks. So the Think and Grow puts out a benchmark that I think KPMG supports. That report comes out every year, and I find that helpful just to keep my finger on the pulse of what the price tag and the equity ranges are. But you heard Charlie immediately say it's about fairness. He didn't say, "Oh, now's a great time to get a discount on talent." People are absolutely your most valuable asset. They're more valuable than the cash that we started talking about at the top of this conversation. And one of the powerful things about long-term incentives or equity is that, as we saw, is keeping people in roles longer. But it allows everyone to act like an owner because they are one.
Yeah.
I think that's really powerful. That's the best thing that equity can do, is it gives everyone a real sense of ownership and a real sense of commitment to what is happening long term. And so that's not where you skimp, because if you do well, that pie just gets bigger and bigger and bigger. And so this is not where you should have a scarcity mentality. You should really think abundantly. And you should, again, you sell the vision of how big this can be, what an incredible impact you'll have on your customers in the world, and your employees will buy that vision and will help to grow that pie for you. So I feel like when we talk about where do we save money, this wouldn't be where I would put downward pressure. I would still, you don't throw away equity. But you think really carefully about what is the right equity package that will make this person feel rewarded, make them feel special, because I think they're the freaking bomb, right? Like if I'm asking you to join my team, I think you're freaking amazing. And how do I give you a package that shows I think you're amazing? And equity is a beautiful way to do that.
Yeah, it is. You get the allegiance and the loyalty long term, and then you also get the personal investment at their level, that they want your business to be a success as much as you do.
Yeah. Absolutely. Another question, any thoughts on shadow equity, downside, upside, given our plans to sell the business or take on future investors in the next few years?
Yeah, I've got an opinion on that one. Right. So it's actually pretty easy to do. And it's fairly tax efficient as well, because at the end of the day, it's invisible, right? So there's no, it doesn't matter if the ATO is on the call. It's because you're not actually you're not actually creating a taxation event. But I'm building something similar, so that if we do have a liquidity event over a certain dollar value, then there's a pool of that cash which then gets distributed directly to the people, That's a taxable event. But that's okay because you've got the cash, right? So you'll happily pay the tax on that bit. It's always been tricky in Australia, because it's not as simple as the US, where you can just get the standard RSU programs. There's been a little bit of change in that recently, and I think Amanda's team are probably the best people to advise on some of the structures around those things and the different ways you can do this. But certainly there's a few options available, and I've actually got part of KPMG advising me on some pieces, and it's pretty straightforward to build shadow equity, and you can even do management, with platforms like Cake Equity and things like that. So you can drive incentives, you can communicate the growth, you can communicate the fair market value. I value our business quarterly based on the Bessemer Cloud Index. So Bessemer in about May did an adjustment for B2B SaaS valuations based on the potential downturn of the market and the cost of capital. And so we sit very conservatively and we just communicate to the team like a fair market valuation. We triangulate from a few different people, and then people can look and go, hey, well, my shadow equity might be worth X, or it might be worth Y over this period of time. And again, that that helps people lean into the business and give it their all, kind of thing. So yeah, definitely worth exploring.
The mental image that I want founders to think about is at the time of a successful exit, and you're raising a glass of champagne, is your entire team raising a glass of champagne alongside you because they feel like they're part of the celebration.
Yeah.
And if you don't have a structural way to do that, then a shadow way is a good way, right? So
yeah,
even if it's not you are communicating, oh, you have this shadow equity, and it's nebulous and it's hard, and not all markets understand it and value it. I remember when I was at Eventbrite before I started Australia, I started an office in Nashville, and I had come from the San Francisco office where like equity is everything. That's like the major part of our package that we negotiate. We go into Nashville. They didn't know what equity was. They didn't care about it. And they certainly didn't want to have to deal with the tax implications of it. They just didn't. But we knew that we were going to IPO within, we thought 2 years. It ended up being 7, bygones, whatever. But one of the things that we did was when we thought from our balance sheet perspective, we put a liability in there of if we had given these folks equity, how much would that be worth? And how would we provide a cash bonus equivalent to that? Now, fast forward a few years later, we actually just spun up equity and we backdated it, and we actually gave them real equity. But from day dot, it was important for me to say, even though these employees don't value it and they're not asking for it, knowing that we are going to IPO, it would feel really bad if the San Francisco office is celebrating and buying Teslas, and the Nashville office is looking around saying, like, what did we miss? So I would always think about, if you're one team and you're creating an incredible something of value together, how do you celebrate together? But as Charlie said, and I bet Robyn and other members of the KPMG team can advise you on these things, the Australian tax structure really sucks in many instances. And when I came to launch Australia in 2013, 2014, that was even before they changed the treatment of stock vesting as a taxable event. So I went into a shadow program. I had a side letter. So nothing vested while I was in Australia, and it was at a point of liquidation. All of a sudden, everything vested. So like there are ways around it, and you could always do some gymnastics. At the end of the day, I wish our ATO would come up to speed with modern compensation structures, because the innovative companies need it in order to attract and retain talent. But I'll get off my policy soapbox and let Robyn talk more tactically.
No, that's so true, Rachel. And I love the image of the champagne glass with who you want to be celebrating with you, because as Charlie said, if you're going to go and do it again, you're going to likely want some of those people to come and work with you. And if you haven't been, generous enough to share the equity the first time around, then there may not be the same appetite.
Yeah. Just quickly, sort of one last question around, we haven't really talked much about extending runway. Rachel, just throw to you. Can you just quickly define runway, and then also how much runway are you telling founders that they need to have and why?
Yeah, that's a great question, because I realized in my rambling answer previously, I had meant to tell you tactically how much runway we're asking our founders to have. So we're asking our founders to have 2 years of runway. And so runway means that you have the amount of cash such that as you continue to exist, that you can stay alive for 2 years. So that means your incomings minus your outgoings, plus the cash you have in reserves, will not get to a negative number within a certain time frame. And we're asking that time frame to be 2 years. Previously, when I would write a check to a round, my mental model was, we used to say that's 12 months runway. I knew that it was probably 9 months if they were moving fast, 18 months if they were going really slow. And so that time frame has extended. It happened at the start of COVID. So in March 2020, that's when we first yelled to all of our companies, 2 years of runway, 2 years of runway. Now we were wrong, right? Because all of a sudden every freaking dollar came out from under the mattress and got poured into early stage. So once everyone was like, stop freaking out, and then they were just bored at home and not going to Europe, all of that money went into startups. So we were wrong. And so I'm a little afraid that some of our founders are going to say, oh, these VCs are crying wolf again. But I really am hammering home, and I'm actually building a detection system because I have over 47 companies in my portfolio. And so one of the things I'm doing now is collecting cash in bank and burn rate, so that I keep yelling at my founders, if you have less than 9 months runway, please talk to me ASAP so we can talk about a bridging round. But I'm actually going to build a system to make sure that I have my eyes on that at all times. So again, the ways that we can get 2 years of runway, we mentioned it. It's the money coming in and the money going out and the cash in bank. So in those 3 ways, we can think about, how do we get revenue? We've talked about that. We've talked about how do we reduce costs, and then how do we get cash in bank? That is right now what I've done in the last 6 months. I've done 8 internal bridging rounds for my portfolio companies. And that is where it's not a formal process. They don't go out and do a roadshow. It's the existing investor saying, hey, you're great. We love you. We back you. We want you to survive. Let's get some cash in your pocket. Now, asterisk, that cash is going to come at terms very similar to the ones that you did at last raise, even though we know you've made progress. And that's not us being assholes. Although we do have a fiduciary responsibility to make great deals on behalf of our investors. It's really just an acknowledgement of where the market is. It's acknowledgement of the additional risk that exists in our market right now. And it's the acknowledgement of how much time we need to secure before we can confidently say that you will have hit your milestones and or downstream capital will be available. And so our founders, they don't no one loves this conversation, but everyone's been really understanding of it. And so we have done 8 bridging rounds at or close to flat terms. From an investment perspective, it's a great deal, but I don't like to think about. I'm not a discount investor. I like to think about it as this is us continuing to back our founders at a price that recognizes the risk that we're taking and recognizes our desire for them to survive.
I love the way you framed that, because I think there is sort of the bridging rounds, the non-talked about, there's a sort of, there can be a sense of not shame, but people just, it's seen as not, again, shame and failure are not the right words, but it's not seen as positive. And I think that is actually a way to think about it. The investors are saying, we do believe in you. We are going to continue to invest in you. And I think that's a very positive way to look at it. Because why would they be giving you extra money if they didn't? But anyway.
Yeah. Listen, you never throw good money after bad.
Right.
So, all of these events become accelerants. So very rarely, as Charlie was saying, the excuse of the external event on bad decisions, very rarely, not without exception, but very, very rarely do we see amazing businesses just become victim of COVID or victim of an economic downturn. What we see is the event becomes the accelerant of the inevitable, because that leader was making bad decisions, that product wasn't solving a real problem, those unit economics were out of whack. So these companies that we are doing bridging rounds don't fall into that. Unfortunately, death is part of our business and we have to let some of our companies die. These are those in the middle that, if in slightly different economic terms, they would be going to market and raising good money, or just sometimes they just need a little bit longer, but we know they're on the brink of something. And, sometimes you need to slip your kid a 20 in the pocket, and that's with a few more zeros. That's what this is. This is
I wish somebody slipped me a 20 in the pocket.
Slipping your kid a little 20 saying, go on, you deserve it. And these are the companies that, we really believe in, we want to see in the world. And so we want to make sure that they get where they need to be.
Great. All right. Well, look, I'm very conscious of everyone's time. So I might just throw to the three of you and just go to key takeaways. So just, sort of what advice, key takeaway would you give to founders as we leave this session? Charlie, do you want to go first?
I'd say just get a clear understanding about what efficiency and any version of austerity might actually mean while you're trying to get through this period, and work your business to be the most efficient version it can be. It's about growing.
Yep. Robyn?
Yep. From a founder's perspective, we're in the new operating normal. So shift your focus to a more rigorous use of your resources, apply that discipline that you need, become really good business people, and realise that at some point you're hoping to produce a profit and start thinking that way. And I guess recognising also that from an investor perspective, they are playing the long game. They're going to ride out any volatility and uncertainty, and they probably will be fine at the end. So they're going to be more selective in choosing where they deploy capital. So make your business attractive by demonstrating that you're using their capital as efficiently as possible and having good business metrics.
Yeah, that's great. And finally, Rachael.
Well, I mean, just listen to Charlie and Robyn.
No one's listening to you.
If I put if I wrap it up in two zingers of things that they've already said, it's, at a certain point, you're not building a product, you're building a business. So if your mindset hasn't shifted to, I am a business builder, buy some books and start building a business. And the second thing is, as Robyn said, we are here for the long term. And so get partners who see that, right? As an early stage investor, I have a 7 to 10 year horizon for my exits. So that means that I'm here to ride out the waves. And I want you to, be on that journey with me. So find the right partner who can guide you through this. And the third is on guidance. Is if you don't know how to operate your business, if you don't know how to attract talent, if you don't know how to mitigate your cost, ask. There are amazing people on this call, KPMG, High Growth Ventures. There's just a number of people that you can turn to support you on your way. But, good luck, get out there. As Robyn said, we're still investing. Lots of folks are still investing. Just the bar of what good is has changed. So if you thought you were good last year, you have to be elite this year. And so if you don't know what elite looks like, or you don't know how to be elite, talk to the folks, on this call, talk to KPMG and others around how you up your game.
Yeah, that's great. And just we've got 1 minute, just one last question, Charlie. Is there a good resource that talks to the 10-40-8 metric you were talking about? The Woody design.
Yeah, so actually go take a look at I was just typing something in there actually. So if you just Google Winning by Design and the word sustainability, because it's called the sustainability metric, I think there's a couple of white papers on winningbydesign.com, but there's also a bunch of YouTube videos with Crazy Jarko talking through it as well.
Yes, all right. Well, look, thank you very much, guys. I thought that was great. I got a lot out of it, actually. It was excellent. So thank you. And we will make the recording available as well on the High Growth Ventures site. So feel free to revisit. All right. Thank you, everyone.
Thanks Amanda.
Have a good day.
Thank you. Have a good day. Bye.
Bye.